I know it's been a while, but do you remember the inverted yield curve where interest rates were highest at the short end of the curve with the shortest maturity debt, and they were shortest with the longest maturity debt, and how inverted yield curves always signal a coming recession, and we had the longest lasting inverted yield curve in history? Yeah, that one? Well, it's gone. In other words, almost the entire yield curve now is completely back to normal, one in which the short-term interest rates are the lowest, and the longer out you go in maturity, the higher the interest rate gets. Now, this has happened primarily because the longer-term interest rates have been rising ever since September of 2024. This might sound confusing because, if you remember, that's right around the time the Fed started cutting interest rates. In fact, if we look at a chart of the Fed funds rate and we zoom in on just the last couple of years, we can see that September of 2024 is precisely when the Federal Reserve started to cut interest rates. So we know that the yield curve has uninverted and returned to a regular yield curve. But how is it that that has happened as a result of long-term rates rising when the Fed has been cutting short-term rates? Well, the Federal Reserve only outright controls the Fed funds rate. This is a short-term and overnight rate that really only applies to banks. It does have a lot of influence on other forms of debt, but the Fed funds rate is the only one the Fed outright controls. The Fed has lowered the Fed funds rate, which was effectively around 5.3% in August of 2024, and as of December of 2024 was around 4.5%. If we take a look at interest rates on very short-term US government debt, like 6-month T-bills, we can see that has also moved down from around 4.4% to around 4.3%. If you're wondering why it started to fall before the Fed started to cut interest rates, it's because the market was just anticipating that the Federal Reserve would cut interest rates, basically front-running that policy move. So the government is a key beneficiary of the Fed lowering rates because they get to borrow with T-bills, which are very short-term debt instruments, and that means they pay a lower amount on that short-term debt. So that is one impact of the Federal Reserve lowering short-term rates. But it can also have a stimulative effect on the economy because if I'm a bank and I can give my money to the Fed overnight and receive, let's say a crazy number, 10%, well, I'm not going to be really that incentivized to lend my money out to a productive person or enterprise in order to go do something productive in the economy. I'm going to need them to pay me 11 or 12 or 13% to compensate me for that additional risk. Otherwise, might as well just give it to the Fed risk-free. But if the Fed is lowering interest rates, it becomes less attractive for banks to keep their money, and now they have a little bit more of an incentive to lend it out to somebody else, especially if there's a corporation that can only afford to borrow if they can borrow at 5%. While the Fed has rates above 5%, that means banks are not going to be that excited to lend to that borrower because they'd be having to accept a lower interest rate by lending to the corporation instead of the Fed. But now that the Fed has lowered rates and that bank can only get, let's say, 4.5% from the Fed, now the bank is more willing to lend to the corporation at 5% instead. So it means more capital is available to productive enterprise. Or in other words, more individuals and corporations can afford to borrow more. Now, if you're wondering what this has to do with the yield curve and why the long end has shot up with long-term interest rates getting so much higher, don't worry, we're going to get there. So when short-term rates are lowered even slightly, one of the results of this is more money added to the system. This is a chart of the M2 money supply going back all the way to 1980, and you can see the big bump from money printing in 2020, and you can see where it topped out. The Fed started to tighten and decrease the money supply, and then it bottomed and has been headed higher from there. Zooming in on just the last year, we can see that the money supply has been steadily increasing, and even though the data on this chart is delayed, it does look like the pace at which the money supply is increasing recently has been accelerating compared to where it was about a year ago. To test this theory, we can take a look at this chart, which is still looking at M2, but it's looking at the percent change in the money supply compared to 1 year prior. And you can see that in early 2024, the pace at which the money supply was growing was pretty slow. But towards the end of 2024, the percentage change in the money supply is much, much higher than it was before. This happens because every loan is dollars being created. That's how the dollar system works. Money is lent into existence. When you deposit cash at a bank, it doesn't stay there. The bank will take that cash and lend it out, which then lands in somebody else's bank account. That bank then takes that money and lends it out again. If you're tracking, you have money in your bank account, somebody else has money in their bank account, somebody else has money in their bank account. That money all says it's there and they all say you can come get it at any time, but it's the same dollar that has been rehypothecated, in other words, loaned out again and again. That's how the dollar system works. That's why bank runs happen and banks collapse, because when everybody goes to get their money, it's not actually there, it's been lent out. But unless everybody tries to go and get their money, it all appears as if it's still there. Similarly, when you go to pay debt off, those dollars cease to exist. That dollar was lent into existence when you borrowed it and spent it, which means when you pay that debt off, it's not just going into somebody's bank account, that asset for the bank ceases to exist. You take money out of circulation, return it, the asset disappears, your liability disappears, and the money supply shrinks. Now, most people since 2020 are aware of the fact that when the money supply increases rapidly, you have more money chasing the same amount of stuff, goods and services. Printing money doesn't increase production. Prices are an auction, which means if there's more money, then there's more demand. More demand means higher prices. More money chasing the same goods and services, higher prices. It's not even and equal. That money works itself through the economy in a messy way, dynamically, and some prices will go up a lot. Some prices will not move much, but all else being equal, increasing the supply of money will have upward pressure on prices. Now, this is also why longer term interest rates have also started to rise. As an example, mortgage rates. When the Fed lowers interest rates, that causes more borrowing and more lending. That increases the money supply, which increases prices. As prices go up, lenders demand higher rates to be compensated for their loss in purchasing power. And the longer out in time you push the duration of that debt, the more chance you have for that inflation to get worse. And so as the Fed lowers short-term interest rates, that's going to have the effect of pushing up long-term rates. This is why we've seen long-term government bond yields go through the roof recently because of inflation expectations. Now, when you compare the relative move in short-term bond prices versus long-term bond prices, the majority of the yield curve uninverting has been from the long end moving more. In other words, over the last couple of years, long-term interest rates have gone from under 2% to almost 5%. Same thing with the 10-year. It has moved from around 1% to, again, close to 5%. Now, short-term bonds, this is interesting, made a really rapid move initially as they followed very closely to the Federal Reserve's interest rates, but flatlined from there. We know that bond prices and yields are inversely correlated. When I borrow money from you, you have an asset called a bond or an IOU from me. You don't have to keep it until I pay you back. You could sell it. If I borrow $100 from you and owe you $105 back, then that IOU is worth $105 in a year. If you sell that IOU to somebody else for $99, I'm gonna owe them $105 back in a year. The IOU doesn't change on the borrower's end. It changes on the buyer's end because the buyer might buy it from you at $99. They're still gonna get $105 back from me though. So for them, the yield went up. So because the IOU's price went down from $100, which it started at with you, down to $99 for the new person, that meant the interest rate went up. The opposite happens as well. You can also say at the same time that the bond price is collapsing. So when we look at something like the 20-year bond and we see that since 2021, the interest rate has gone from under 2% up to almost 5%. That's why something like TLT, which invests in buying those 20-year bonds, its price has gone from about $150 down to $86. So even though interest rates have only moved up a couple of percentage points, that can have a massive impact on the price of the bond itself, which is why TLT is almost half of what it was worth a few years ago. This means that over the last couple of years, as the yield curve has uninverted, it's been what's called a bear steepener. In other words, the bond prices were moving lower. It was a bear market for those bonds, and that is what uninverted the yield curve. If we had recently seen short-term interest rates just collapse and go back down to zero, that would mean that short-term debt, the price of that debt, those bonds, would shoot up higher. You would have a steepening of the yield curve as a result of short-term bond prices getting more expensive, the yield on those short-term bonds collapsing, and the yield on the long-term bonds not changing much. You can have bull steepeners. That's not what we had this time. We had a bear steepener. Short-term interest rates dropped a tiny bit, but long-term interest rates have risen a lot, which means it was a bear market for those bonds. Bear steepener. Now, if you've been following me for any length of time, you know that for years, I've been telling people to avoid treasuries like the plague. And this is why. Because this is what you get in this phase of the long-term debt cycle. When a nation's debt to GDP reaches 120%, they're monetizing their debt. They can't tax their way out of it. You don't want to hold those bonds because if they leave it up to the free market, there will be a deflationary death spiral. They'll default on the debt. They're probably not going to do that, which means the only way out is to print. This means the price of those bonds will take a hit, and if you need to sell them, you won't probably be able to sell them for as much as you originally spent on them. But if you hold them to maturity, you're also going to get screwed because you probably won't get back as much as you lost from inflation along the way. For anything short term, it's fine. If you want to be in T-bills or money market funds, that's fine. Cash on the sidelines, needing some liquidity for a large purchase, but it doesn't belong as a significant portion of a long-term allocation in your portfolio. And anybody recommending a 60-40 portfolio, modern portfolio theory, is just stuck in the 20th century and doesn't realize the impact that monetary and fiscal policy have to have on the economy moving forward for the foreseeable future. And by the looks of it right now, long-term interest rates will continue to have to move even higher to attract the capital that the government is looking to need. As always, thank you so much for watching. Have a great day.